part 2 of our chapter 2 lecture on how to assign product costs using a job order cost system. We left off on job A-143 where we see the job cost sheet. This shows the total cost for materials, labor, and the amount of overhead costs assigned to this job based upon the predetermined overhead rate. They gave a total cost of $268. We produced 2 units, 2 of the wooden cargo crates, which means that the product cost is $134 per wooden cargo crate. So we can use a job order cost system to assign costs to each individual job. For example, we have job WR53 required $200 of direct material, 10 direct labor hours at $15 per hour. The estimated total overhead for the year was $760,000, and estimated direct labor hours were 20,000 hours. What would be recorded as the cost of job WR53? You thinking about it? Okay. So remember that your product cost consists of direct material costs, direct labor costs, and it consists of your manufacturing overhead costs that we're going to assign to each individual job. So first determine what is my predetermined overhead rate. You take the total estimated overhead for the year divided by the total estimated direct labor hours, and that gives us a predetermined overhead rate of $38 per direct labor hour. Now this job requires 10 direct labor hours. So to assign the overhead cost, you will take the 10 direct labor hours times the rate of $38 per hour, gives a total cost of $380. Your total cost consists of your material cost, labor cost, and the overhead cost assigned to each individual job. Therefore, the total cost to be assigned to job WR53, as you got correctly, would be D, $730. Okay? Now, it is important that a company choose the correct allocation base, meaning we're saying what factor is the cost driver, what factor is going to have the most impact on the manufacturing overhead cost. Again, is it the number of hours worked by the employees? Is it the number of machine hours that's going to be used? So a company must look at their historical information and try to figure out again what is the cost driver, or sometimes there could be cost drivers that has the biggest impact on the manufacturing overhead cost. For some companies, they use what's called a plant-wide overhead rate. They may say we're going to assign overhead costs based upon direct labor hours. Okay? Sometimes that is too simplistic, and it will cause them to assign an incorrect amount of overhead to each job. To be more accurate, others use what's called multiple predetermined overhead rates, meaning that they may use an overhead rate in one department that could be machine hours compared to another department, it could be direct labor hours. They look at, again, which cost drivers has the biggest impact on the estimated manufacturing overhead cost. For example, we have the Dixon Company, and they have 2 production departments, the milling department and the assembly department. Okay, so here's the information about them, but notice that for this company, they're going to have multiple predetermined overhead rates. In the milling department, they're going to assign overhead costs based upon machine hours. But in the assembly department, they're going to assign overhead costs based upon direct labor hours. So they figured out which cost factors has the biggest impact on manufacturing costs in these different departments. So in one department, they feel that machine hours would be the biggest cost driver. In the assembly department, they discovered that direct labor hour is the biggest cost driver for the manufacturing cost. In addition, the actual selling price of these items will be a markup of 75% of the total manufacturing cost. So we get to that point, remember that to try to determine the sales price is going to be a markup of 75% of the total manufacturing cost. Okay, let's get to our calculations. So first, for the mill department, we have to figure out what is going to be the predetermined overhead rate. So we'll take our, sorry about that, we'll take our fixed cost plus the variable cost per hour, which is $2 for machine hours, and they expect to be 60,000 machine hours. So the total overhead cost in milling is $510,000. In the assembly department, we take our fixed overhead cost. The variable overhead rate would be $375 per direct labor hours. We expect for the year to use 80,000 direct labor hours, so the total overhead cost in the assembly department is estimated at $800,000. Once you have your total estimated manufacturing cost, in the mill department, we'll divide that by the machine hours expected to be used to get an overhead rate of $850 per machine hours. In the assembly department, we're going to assign based upon direct labor hours to get a rate of $10 per direct labor hours. So now we have two separate overhead rates. One in the mill department is based upon machine hours, and the assembly department is based upon direct labor hours. Okay, so let's continue now. So for job 407, in the milling department, there was a total of 90 machine hours. And remember, the overhead rate was $850 per machine hours. So the overhead cost assigned to in the milling department for this job would be $765. So again, you took the machine hours in the milling department times the predetermined overhead rate. We're going to assign overhead costs of $765 in the milling department. For our assembly department, direct labor hours were 20 hours, and that predetermined overhead rate was $10 per hour. So a total of $200 is going to be assigned as overhead costs in the assembly department. Okay, so now we have material costs and labor costs for each, and we're now going to add in the overhead costs in each of these different departments. All right, so we add in the overhead costs in the milling and assembly department to get a total cost for this job as being $2,485. So once again, we assign costs based upon multiple predetermined overhead rates. We assign a cost in milling based upon machine hours. We assign a cost in assembly based upon direct labor hours. Okay? Now recall that the sales price will be a markup of 75% of the total cost. So 75% of the cost would give us the 1,863.75. Add that to the cost to make product job 407. So this job will sell for $4,348.75. Now, before we can determine the selling price of a job, we must have an accurate amount for the total cost to produce the actual job. Because again, the selling price is a percentage of the total cost to produce job number 407. Okay? Now, the overhead that we're applying, it could be underapplied or it could be overapplied. Underapplied means that we apply less overhead to a job than the actual amount that incurs. Okay? Overapplied means that we applied more overhead to the job than what actually incurred. But remember that we don't really know the actual overhead cost until the end of the year. All right. So we estimate overhead costs early on based upon the predetermined overhead rates, or if possible, based upon the multiple predetermined overhead rates. So what happens is that we're going to make an adjustment at the end of the year into what's called the cost of goods sold account. Cost of goods sold. Perhaps you're saying, what is cost of goods sold? I am glad you asked that question. Cost of goods sold is an expense account that is shown on the income statement, and it represents the actual amount that a company paid to either purchase or produce an item. So for our example, cost of goods sold for job 407 would be $2,485. That was the amount of cost we assigned to job 407. What we're saying now is that if the overhead applied was underapplied, go back. If the overhead applied was under, I'm going to assign the additional overhead cost to the cost of goods sold account to make sure that account is now accurate. Or if the amount of overhead applied was more than what it should have been, I'm going to decrease the cost of goods sold, which again is an expense account that's going to be shown on the income statement. So at the end of the accounting period, we make an adjustment for each job to see whether the overhead applied was under or over. And based upon whether it was under or over, the adjustment is made into an expense account known as the cost of goods sold account. Okay? So the job cost sheet that we prepare for each of our jobs, or what we call financial records, they are used to report on a balance sheet two different types of inventory account, what we call work in process inventory and finished goods inventory. Work in process means these items are not 100% complete. So we're working on the completion of a job, but it's not quite complete. Finished goods means the job has been completed and now the item is ready to be sold to the actual consumers of the actual business. So in accounting, we have to keep track of all of our costs, all of our expenses, and with a job order costing system, these job cost sheets are used to show the amounts in our work in process account and what's called finished goods. And these two accounts, which are inventory accounts, are shown on what's known as a balance sheet. We'll talk more about the work in process account and finished goods when we continue to our lecture on job order cost sheet in our next chapter, which is chapter 3. For now, that will do it. Have a good one.